Adam, how are you, man?
I'm good, Ryan. It's good to be back. Of all the podcasts I've done, and I think I've done like 150 or something like that. Now,
Whoa.
I have to say, the first time you and I got together was one of my favorite. And whenever someone wants to hear a podcast, I send them to yours first because you were so high energy, and it was like you and I had a similar kind of energy level, and it just really worked magically. So
That's
good to
awesome,
be
man.
back. Good to
I
be
actually,
back.
I have to say that the comments on our YouTube episode are probably the only YouTube comments I actually comment on because it's a bunch of people rallying around the topic. And I got to ask, there's no way I have more energy than Tommy Mello. There's zero chance.
Yeah, you know what? I don't. So Tommy, another friend. I don't know. I don't know if he lives on an IV of Red Bull or just, but he's got a ton of energy too. I got to give you that. And
Yes. I when he was on the show last, I was like, I don't know if I just tossed him up a couple of questions and he just went with it.
yeah,
But you're on the show again because you pumped out another book since we talked last. And I know we covered a lot of ground on the last episode, so we got that in the archives for people. I just wanted to know. Let's start with like why another book? What was your intention with the book and from the
yeah. So,
audience?
so this book is called Empire Builder. The road to a billion. And so if you remember the private equity playbook, so the other ones are up there.
Mm-hmm.
The private equity playbook was my first book, but it was subject matter oriented towards private equity. And I felt like there was this whole generation of entrepreneurs who just really don't understand private equity. And that hasn't changed. Completely hasn't changed. I still give this same 10 question multiple choice quiz to people, and I do a seminar or whatever, and I've got very smart people, some people with hundreds of millions of dollars in revenue, and 90+% of the room fails miserably. And
Is it that high?
usually the high score is about 6 out of 10. It's a 10 questions, 5 choices each one. And so, it's that book still sells. This morning I woke up, it was number one. It has literally for 4 years since it was released, continue to just be it has a cult classic. Anytime someone wants to understand private equity, they go to that. The exit strategies, playbook, same thing. These are bookends. The exit strategy playbook, also subject matter oriented towards just, you got a business, you've built it, it's time to exit. Who's the universe of buyers? How do I get the best deal? And how do I navigate that when it's my first time and I've never done it before? What makes Empire Builder fun was, so while those two are subject books, this is the journey. So this one is, I literally lay out the roadmap on how to go from 0 to 100,000, 100,000 to a million to 10 million, 10 to 100, 100 to a billion. And I lay out all the stages of growth, what the tools are that you need to understand in order to go from one of these swim lanes to another. And then I also, the focus areas are different, and it was a lot of fun. And it came out of my first 2-day seminar that I taught, which was called Empire Builder. And so I had a 350-page PowerPoint deck, and I went into this seminar knowing that this was going to become a book. And
Got
that's
it.
how most of my books start, is like a college lecture or something that I've been working on, I've been perfecting and teaching. And so I went into this seminar knowing that the people in the room didn't know that this was going to become a book. So I taught the seminar in February, literally March 1st. I sat down and I started writing. And business books have a certain format to them. The publishing world would love 40,000 words target, 12 chapters, 4 sections, 3 sections each, and intro and exit. It's like there's a very prescriptive formula, because if you get too many pages, nobody can make any
The
money.
ADHD entrepreneur is not going to read it, right?
It costs a lot if you got a 1,000-page textbook that you can only sell for $29 instead of $3,000. So it's a very prescriptive formula. But what made this one fun was I really kind of busted into. First of all, I did a lot of research. So statistics are really scary in business, and so I'm using American statistics because they're published on the government websites and easy to get. But there's 33 million small businesses in America today, and of those 33 million, only 7% ever get to $1 million of revenue.
Mm-hmm.
And of those, only 4% of the 7% ever get to 10 million. And I'm a guy who's built hundreds of millions of dollars. And it's like, I'm like, why is it so hard to
Mm-hmm.
succeed? And then there's the other statistics, which is like, in the first 5 years, more than 50% of all businesses that are started fail. And I'm like, why can't people get this right? So I did digging, and I bought 58 companies over the years, smaller businesses that I put together to build my bigger empires. And so as I was doing my research, I'm like, you know what? I think I understand. And so I started laying it out for people. And it's like, when people are starting out, what I find is before you worry about building a 1 million or 10 million or $100 million business, before you build something big, you got to build something that works small. The
Mm-hmm.
first 100 grand, the first million, just key to success. And it's all about unit level economics. So I came up with I call it the law of 30 20 10. There's the 30 20 10 rule. And I came up with a methodology on how a person can create a prescriptive formula to ensure their success going to a million. How can you be that perfect? How can you be one of the 7% that gets to a million? I'll
Mm-hmm.
show you how to build a perfect business focused on unit level economics, focused on producing at least 30% gross margin, gross profit, less than 20% SG&A, minimum 10% net profit, or higher. And
Mm-hmm.
I build this mythical landscape maintenance business because people can wrap their head around what are my unit level economics. It's one truck, it's a
Mm-hmm.
two-person crew, a mower, a weed whacker, a blower, a rake, a shovel. And it's like we build this mathematical formula. How much revenue can this crew produce? What are the costs, operating costs for the truck and for
Mm-hmm.
the weed whacker and the blower and the mower, all that stuff. And so I guide people from startup through defining your unit level economics. Even before that, I focus on, in today's world, it's so volatile from an economic perspective. It's like we have to start by focusing on needs, not
Well,
wants.
well, I like, so when I was going through your book, and I think there's a couple other concepts I want to weave in here too, because like I'm recently on this kick with Harvard Business Review's article from the '80s, the 5 stages of growth. Are you familiar with that at all, Andam?
I
Uh,
am. I know
it's
which one you're talking about.
Yeah, like I don't know how the hell it took me that long to get exposed to it, but they talk about the 5 stages and how the complexities grow. So here's why I'm asking this question is because when you were going through your stages, I love the fact that you addressed it and you didn't be like, hey, it's a billion, and I just got here because I was already sitting on $100 million in revenue and 15 million in EBITDA, and I hired an EY, and like
Yeah.
you acknowledge how freaking difficult it is to get through each of these stages. And so how, like, here's kind of what I've seen in the stages of companies that we've worked with is the complexities in the cash flow working capital become this strain because the owner finally goes, I'm making 150. And then like,
Yeah.
just hire a GM or another truck. And they're like, with what cash? So
Yeah.
there's like a combination of maybe not the visibility where like you paint how you can go all the way up, but also the more mechanical of the cash flow and the complexities of it. How do you what would you say to someone that's listening in that when they hear the word billion, it kind of freaks them out? Because I think you
It,
do a good
it
job
does.
with that.
It does. So not too long ago, a famous billionaire asked me to come to his house on a weekend and talk to him about a business he owned. Then everybody in the world knows I got an NDA. I can't talk about names, but it was struggling. It's like I've been through 3 CEOs in a short period of time. It's like no one seems to be able to address my core issues. How do you fix world hunger? I'm like, you don't. That's the key. You don't fix world hunger. You fix one truck, one service call,
Yeah.
one
Yeah.
event. And if
Right.
I can make one work, I can make 6,000 work, and I can replicate that math and that formula. And how many entrepreneurs have we heard that come to us and say, oh, Adam, Ryan, don't worry about it, when I get bigger I'll figure out how to make money? And I'm like, no, wrong answer. If you can't make money small, you're never going to make money big. What we want is to make more money as we get bigger because we're creating leverage, but it's got to work small. And so I did research on numbers. I really dug in. I bought 58 companies from entrepreneurs, who were successful. They beat the odds. They
Mm-hmm.
built that $1 million, $10 million. Most of them seemed to top out at about somewhere between 20 and 30 million. They ran out of bandwidth. And so I really just went in, broke it down, and I started with some personal lessons that I learned in life. And it started with Warren Buffett. Some of his advice, which was invest in what you understand. And I translate that to invest in what you know. And I gave an example from my life where I took $100,000 I invested in five different stocks that I knew. I looked at my life. What do I know? I know Amazon comes to my freaking house at least 2, 3 times a day, and all my neighbors' houses 2, 3 times a day. All my devices are Apple. All of my applications, whether I'm on a Mac or a PC, are going to be Microsoft based.
Mm-hmm.
I just I go to Home Depot every weekend. I don't go to Lowe's. Lowe's for decorators. Home Depot is for dudes with trucks, that build stuff. And so, I just inventoried what I knew. I invested 100 grand in each of 5 stocks. 5 years later, I had a $2.5 million return. And, and so then I translate that to companies, and, and the translation is invest in what people need, or build a company around needs, not wants. When I need my roof fixed when it's leaking and there's water pouring on my head. I want a new truck. I want a new outfit, but I need, food for my pets or whatever. And I go through examples for product based companies,
Mm-hmm.
for real estate investors, and then for services type investors. And then, okay, so we because of cyclicality, we want companies, if I focus on wants,
Especially
there's
now, Adam. I don't know. Like I've been diving. I've got ITR economics on the podcast once a quarter, and they're talking about the 2030 Great Depression is how they call it, or
yeah.
like what's going on with 2024. I mean, what you're talking about, needs versus wants, is like insanely important in my mind.
Yeah, especially if we're building a company, because if my business is based on wants during a recession or depression, I can literally forego my expense forever. One of the empires that I built was a large commercial laundry company, and what I learned during the Great Recession, 08, 09, was that unemployed people don't do as much laundry as employed people. However, even when you're unemployed, you still got to do laundry, right? So, needs versus wants, very important to not, being somewhat insulated from the effects of an
Mm-hmm.
economic cycle. And then, I love services businesses personally, simply because there's low capital expenditure requirements. And in this mythical business that I build in the book, as we're getting up to, if you want to build a $10 million landscape maintenance business, it's going to cost you about $1.5 million in capital expenditures to do that. But it throws off $1.5 million in free cash flow per year. And so, I have a net ultimate return on investment of under a year in order to, but if I wanted to build a real estate business that had 1.5 million of free cash flow a year,
Mm-hmm.
then, I'm probably looking at anywhere from a 30 to a $60 million portfolio of rental
Yep.
properties.
Yep. Yep.
And so, insanely different kind of capital expenditure requirements for a real estate business versus just a pure services business. And so we walk through, how do I build the formula? How do I make a capital expenditure plan? And then what is the behavior as I'm rolling through the first million? And then at a million, I've dialed in my unit level economics. I'm now
Mm-hmm.
one of the 7%. I'm successful. And as I'm going to 10 million, I'm now starting to add ancillary revenue streams. So I'm cutting a lot of
Yeah.
lawns.
Yeah. I was gonna say, are you gonna get into your you got your organic levers, and maybe you can kind of give it like. Oh, if you kind of go, I'm sorry to derail if you were already going to go here, but you were
No.
talking about your third. I'm still hung up on, not hung up on, and I've cemented your 30% CAGR when you were talking about 10% organic, 10%. I think it was M&A acquisition. Was the other 10% pricing? I can't remember what it was, but they kind of throws into your organic levers. But it maybe kind of clear up
So
that.
that's another lesson in here too, is, what's a good growth rate? Well, it needs to be 30%. If I've got a company with a million in revenue, and I'm growing at 10%, it takes 7.2 years to double it to 2 million, 7.2 to go to 4 million, 7.2 to go to 8 million. I'm 21 years down the road, and I'm not even at 10 million in revenue. So if I'm going to build a true empire, 10% is too slow a growth rate. And so, at different levels, as we get to different sizes, I start adding new tools. This is the size and stage where we want to start thinking about mergers and acquisitions. This is the size and stage we want to think about our first exit, because I recommend to everybody, as volatile as our world is today, I hate to see entrepreneurs that have 90% of their net worth tied up in their companies who are getting older in age, and they're assuming so much risk. So I'm telling people, it's like in my mythical business, we can take our first exit as we approach around 30 million, at 15% EBITDA. I'm sitting at about 4.5 million of EBITDA. And I
Mm-hmm.
could ring the bell for, call it, between 30 and 40 million on this mythical company. Or I can keep pushing on and head to 10 million and look for that 100 to $150 million kind of sized exit. But I tell people there's no way on earth you should build an empire, that has hundreds of millions of revenue and do it alone. And I think that it's important for entrepreneurs to ring the bell, to have multiple exits. And it's okay to become a minority shareholder. It's okay to have an institutional shareholder alongside as your controlling shareholder. You keep building the empire, but you keep taking, every 3 to 5 years when you're selling it, you're taking chips off the table. You're
Mm-hmm.
storing them against an uncertain future. And meanwhile, as you're continuing to build and roll forward, when I build a spreadsheet with entrepreneurs today, and I say, where's your business at today? What's the revenue? What's the earnings? What's your growth rate? Let's plot this out for the next 10 years. When do you think you'd sell it? How much do you think you'd get for this business? Now let's do it my way. Let's do it a different way.
Well, first of
Let's
all, could
monitor.
anybody answer you? Like, what percentage of people could answer that first question?
Yeah. I even talk about that, early in the book, where I'm talking about, I think my background as a pilot taught me how to think about, I don't take off without knowing where I'm going and what my destination is. And so as an
I love the
entrepreneur,
picture. I know.
yeah,
I loved it.
as an entrepreneur, it's like we start a company, we need to know where we're going. It's
I
not
know.
some undefined destination. For me, for most entrepreneurs, look, I'm looking for you to do one of two things. Build an empire on your own that gets to 4 million of EBITDA, or one that gets to 10. And then we're going to sell it. And once we sell it, now we're going to bring in an institutional shareholder. And every 3 to 5 years, as we continue to build it, we're going to sell it again
Mm-hmm.
and again and again.
Mm-hmm.
And we open up, as we get to different sizes, new tools like mergers and acquisitions, and we're creating operating leverage as we're getting bigger. In the beginning, we're an anal retentive control freak, and
Yeah.
as we get bigger, most entrepreneurs hit a glass ceiling about 20 to 30 million in revenue.
Why don't you unpack that? Because that's the second time you mentioned it too. And
Yeah.
our family business topped out at 21 million, and I can tell you all the reasons why we did, and it'd be interesting to hear.
Yeah. And so remember, I bought 58 companies about this size,
Yeah,
right?
right.
That were 20 to 30 million or so in revenue. And the entrepreneur, to be successful, to beat the odds and get to that be the 7% that gets to a million, or the 4% of that got to 10 million and bigger. Every one of them had to be an anal retentive control freak. And so I'm not an orchestra guy, but what I say is, if you think about it this way, in an orchestra, there's sections, and every section has a first chair player. That's the best of the section, the best in the woodwinds and the best in
Yeah,
percussion and
yeah.
what have you. And I'm like, when you're an entrepreneur building a business, you're an anal retentive control freak. You're the first chair player in every section of the orchestra, because the only way you
That's
can be
perfect.
successful is to make sure everybody does the same thing, and replicates your model for success. But eventually you run out of bandwidth. Where you get, the entrepreneurs that can go from 20 to 30 million to 100 are the ones who find another gear. And in that gear, they become the conductor of the orchestra
Yeah.
rather than the first chair player. And instead of managing events, you manage process, and you hire a team of people who are now
Mm-hmm.
managing the minutia that you no longer have the bandwidth to manage. And if you can make that shift, that sets you off on a trajectory to go from
It's
that
a whole
20 to
different
30
mindset shift, isn't
to
it? Like
100. It is.
I don't know if you're familiar with Joel Trammell. He was on the show a couple months ago. He wrote the chief executive operating system. So it's super fascinating. How he words it, Adam, is when you go from, and I'm curious, like out of all the 58 companies you bought, how many people had this? There's this issue with the individual's abilities, not the business's abilities, where there's
Yeah.
a relationship and a high correlation where he says that people have to go from managing tasks to managing and getting things done through people. That's the
Yeah.
shift when they become that CEO. I've struggled with that. I know my father did. A lot of our clients do, because they're the technician or operators first, and then you get to that point where you feel like you're on the top, but you're really just kind of like have one. You have these, like the first row, like you said. And
Yeah.
what I'm also curious, like, because when I'm thinking about this journey upwards, like you're talking about, Adam, it's the business and the growth rate that you've identified, and then what I find super fascinating is you talked about like the ability to reinvest in the unit economics tied to this is the investor or lack of investor mindset that the original founder has. Because like what I've noticed, Adam, over the last decade that I've been doing this, it's the ability for the owner to think like an investor. It's like, you know what I do, Adam, when I'm in my seminars? I'm like, I say, we get into this whole conversation about leadership roles versus ownership, because so many people call me up. They're like, Ryan, I want out. And for years, they try and solve their problem. And then I'm like, what the hell you want out of and where are you going? And no one can answer that. So then my point is that people would say, well, I want out of employee issues, supply chain issues, my customers, the margin compression. I'm like, that's a job. No one
Yeah.
was talking about their equity position and the trade-offs between distribution and reinvestment, which there's almost like two paths that I'm seeing it as you're breaking this down. It's like the growth path of the business and what's the mindset investor anticipate or desire for that original founder. Because like as you were talking about it, it
So, and
changes.
and that's why I think, like, in a 5 hour reading this book, I unpack all of this stuff, but I
Mm-hmm.
unpack it all in order. You and I will jump around, and talk about different rabbit holes and stuff, but it's like I unpack it all in order. It's like, this is what you should be thinking, and as you're getting to different sizes, here's the behavior you need to exhibit to be successful. But as you get bigger, there's new behavior now that you need to get successful. And as we get to that point where we're running out of bandwidth, I talk about the need to become this conductor rather than the first chair player. And you know what? If you can't make that journey, then hire somebody, who can, but the bottom line is, it's too risky in today's world to not at some point sell the business the first time as an intentional event, to not just create, I'll call it generational wealth for yourself or get money off the table. And that becomes your protected nest egg. But then, because I want to use other people's capital and I want to accelerate my growth trajectory, and I'm okay being a minority shareholder. So like here's a great example of this. So who's the richest person in the world today? Is it Jeff Bezos? I
I
want to
feel like
say
there's a Saudi Arabia, someone or another.
probably. Okay,
I'm just kidding.
for,
I'm just giving you crap.
for a while it was Jeff Bezos, and within last year, it depends on Amazon stock's price at the time, right? And Elon Musk, all these people, but Jeff pointed something out recently that really stuck with me on an interview, and I may misquote the number, but it's something like he's only a 12% owner of Amazon, and he's the richest person in the world. What does that
Mm-hmm.
tell you? You can
Mm-hmm.
become the richest person in the world without owning 100% of your business. And
Mm-hmm.
I love the fact that, I'm all about diversifying risk. And so a part of this journey is building a team. And I talk about building the team in here. And it's not just, a team of lawyers and accountants. I also now include in this book, we need wealth management advice.
Mm-hmm.
We need people to help us. We become good at generating. I'm the goose that laid the golden eggs, but I don't know what the hell to do with the eggs once I've got them, right? So I
Totally.
have a wealth management team that manages my wealth. I manage the private equity type investments because I'm an expert at that. But all the rest of it, I throw
Mhm.
it all over my shoulders, and I have a team of people that help me
What
invest.
are some of the what are some of the behaviors of the 58 companies and owners that you've bought? and their relationship with their business and their wealth and their mindset is like associated with their business? Like, did they view it as wealth or paper wealth or fictitious, or how did they think about it?
So I don't want to throw anybody under a bus. These are 58 really good people, and they're all successful. And some of them had built and sold multiple businesses. I wrote about it recently in Forbes, and I called it the arrogance of success, the unintentional arrogance
Hmm.
of success. And I say that in a loving way. When we beat the odds and we build a business that frankly 93% of the world couldn't build, and then we've gotten to all these different levels, we start to have some kind of feeling of invincibility. I know everything. Because I know everything about my business, I know everything about life. And as a result, people start to either make mistakes, or they just find that as they outstrip their own capabilities, they top out, and they don't know how to get further, how to get higher. And I look at life as an educational opportunity and experience. If I'm the smartest guy in the room, change the room. I need, there are times where I'm teaching a seminar, I'm supposed to be the smartest guy in the room, but there's other times in life where it's like, you can't grow unless you're getting getting exposure to new ideas and new things. And by,
Well,
whether
and
it's
don't you
working with
think too,
peer
Adam,
groups
like,
or coaches.
right? And don't you think, like, when you think about at the end of the day, and this is where all things considered, with the shitstorm that's going on with interest rates, supply chain issues, geopolitical issues, employee issues. I mean, you
Yeah.
name it. We don't have a short list of those things going on. No matter what, the name of the game is sustainable, predictable, and transferable future cash flow.
Yeah.
And the moment that we forget that is when I think, to your, what I'm hearing out of that too is the moment that arrogance is blinding us from the things that could sabotage our future cash flow, and we think we're too confident, then like you're just taking unnecessary risk because of your own
You,
ego.
you are. And so there's a second stage to this too, which is interesting. So I call the unintentional arrogance of success as one piece of it. And that
Mhm.
usually happens, when we're building these empires. But there's another bucket of it that occurs when we get over about age 50. If we have not monetized our event, if we haven't, taken some asset diversification, gotten some chips off the table, we start to get conservative again, and we worry about the future and all the volatility, and geez, I'm going to retire soon, I better not open that new branch, I better not buy that new piece of
Mhm.
equipment, or that I better not make these investments. I'm on the downward stroke now. And as a result, we start making bad business decisions, and we prevent our success from getting higher because we become risk averse. And so when I tell people you sell, bring in a partner, roll forward, continue as a minority shareholder, when I've got the wealth diversification handled, I can go back to being aggressive now. And I am,
Mhm.
it's almost like going to Vegas, and it's like I'm on a blackjack table and I'm up so much. I put my original money back in my pocket. Now I'm playing with house money, and, I can get aggressive. In business, same thing. Is that as I get the diversification, I can be in my 50s and 60s, and I can swing for the fences because I'm using someone else's money. I'm a co-investor now as a minority shareholder, but I can remain aggressive and look for growth opportunities and pursue them. And so I see
Well,
the
and
arrogance.
I want to drop out an amazing example. Cami Graff was on my show. I don't know if she's familiar, you're familiar with her, but she, TaxAct was the software that she created.
Yeah,
And so, like, I mean, it's one of the top three. The DOJ stopped her sale to Intuit for, I mean, like, that's when you're on the radar of other people. And she sold to PE. Amazing story. And her whole deal was, she goes, we were getting conservative, even though they were like printing money at them. Oh my
yeah,
God, dude. Yeah. Anyways, ridiculously profitable business. But she said that how the IRS was going through things, that they ended up having a free version that was tied onto the IRS website. That she's like, we never would have done that otherwise if it was only my asset. She goes, but we decided, because we all sat down with a shared pool of money. We said we're all willing to take this risk, which is a really cool example.
yeah. And so it's important. And I think as entrepreneurs, we get so immersed in our day-to-day business and lives that we don't see these larger events. And it's like I'm a pawn on a chessboard, and I'm one of the pieces on the board, and I can't see the forest through the trees. And so I try to teach people how to, kind of get up above the chessboard and reassess and become strategic again. And there's different levels as we're building these businesses where these issues come into play. And so, as a guy who's been on the journey and has had $1 billion exits, in my past, it's like my goal and objective now is to help others be successful. I wish someone would have handed me my books when I was 21, instead of me writing them, at age in my 50s, and now 59. And so much wisdom that we can learn from other people. And it's not that I was God's gift to anything. It's that I made every mistake you can
You did
make
it.
over a 35-year period. And so as a result of that, you don't have to, because
Pardon the brief interruption. I hope you're enjoying the conversation with Adam, and specifically about how fluidly we're talking about valuations, deal structures, getting a return, and how operations tied to the ultimate return of growing a valuable company. One of the best ways is to view your company as a financial asset and look at your numbers in a light that you probably haven't seen before. And if your financials are organized in a way that makes sense, where your operational data is tied to all three financial statements, the income statement, the balance sheet, and the cash flow statement, you tie that to a target valuation at a point in time, so your target normalized EBITDA, you can reverse engineer your entire plan. And if that's something that is of interest to you, all you have to do is book a short discovery call with me and my team, where I want to know a little bit more about you, the business, where you're at right now, and where you want to go, and some of your challenges. We'll walk through our offering of the financial dashboard offering versus the CFO services. And if it's a good fit, we offer a complimentary financial assessment where my team will plug in our financial dashboard, analyze your numbers, and then come back with our thoughts and a view of the dashboard, in the spirit of trying to figure out whether it's a good fit to work together or not. There's no obligation, but it all starts with a discovery call and then a potential complimentary financial assessment if it's a good fit. Thanks everybody for tuning in, and I hope you enjoy the rest of the interview with Adam. What I like about the approach that you're taking, Adam, is it's you were an operator doing it, right? And that's one of the big things that I'm trying to make sure people continue to remember is like, who's giving you the advice? Is it academic or
yeah,
academia, or is it someone that I said it with, I had a bunch of my entrepreneur buddies, like, unless it payroll, if someone managed payroll, working capital, and taxes, I'm willing to give them a
yeah,
solid listen. And
yeah,
one thing that, when you talk about you've been through the journey, there's a couple of things I want to touch on is, in whatever order you'd want, is the pyramid, the EBITDA multiple and
yeah,
arbitrage pyramid, but also I don't want to forget, and that's why I'm dropping both these seeds right now, is the evolution of the day-to-day activities that one of these founders could find themselves in. Because I think, Adam, that is a very fascinating journey where, like, as you know, we'll unpack the multiple arbitrage and that, because that's really like the wealth creation, and the CAGR, 30% CAGR, and that EBITDA pyramid is
yeah,
amazing for wealth creation. And I think the listeners will grab onto that and get it. So maybe we tackle that first. But then I think, Adam, you know what I think a lot of people struggle with, that I come across, like, with, because I've done like almost 40 Vistage workshops this year, and like a dozen keynotes too. So similar to you, I got this huge exposure to these entrepreneurs, but they don't know what the day-to-day responsibility and the job looks like
yeah.
after a certain point. So I think that's one of the limiting things outside of the finance side. So I don't know which one of those topics you want to tackle
Yeah, well,
first.
let's start with what I'll call the PE pyramid, or what I like to call the PE pyramid. And as we're building companies, so again, I told you there were 33 million small businesses in America. I like to think of private equity, and why should we care about private equity? Because there's $5 trillion plus of it. It's the world's largest non-bank lender to business. It's because of private equity that there is a market we can sell companies to, other than other people who want to come in and run them. And so they've created the market for selling
Mm-hmm.
companies. And so our goal and objective is to build wealth, and we do that by increasing the size of our empire. And I like to tell people, imagine, if you will, a pyramid. You're looking at a pyramid, and the pyramid has 5 layers. Each of those 5 layers represents what I call a swim lane. So there's 6,000 PE firms, and they're aggregated up the side of one side of the pyramid. And you've got really big firms at the top, like KKR and Apollo and Blackstone, and people that we all know, and then there's thousands of firms, all up and down that pyramid. They all do the same thing. They all invest 6 to 8% of their fund in one company. and they all can't invest more than about 12% because of asset diversification. Their desire to not have too much invested in any one company. And so they all do the same thing. They're all looking for the same return. And that
Mm-hmm.
means if I'm Blackstone at the top and I got a $30 billion fund, I can't buy small companies because it would take me 1,000 years to put all my money to
Yeah.
work buying small
Mm-hmm.
companies. So big firms buy big companies, small firms buy small companies. As a result of that, there's five natural layers to this pyramid. And every time we step up one level, we're rewarded with multiple expansion. So the amount of money that our business will sell for goes up because as we get bigger, we're climbing the pyramid, and the pyramid's getting narrower at the top. 33 million small companies just in America in the bottom. At the top of the pyramid, only 3,000 companies on the planet with more than $1 billion in revenue. And so as we get bigger, we get rare. As we get
Mm-hmm.
rare, we're more valuable, and bigger funds will pay much more for our business. So our goal really when we're building a business, it isn't getting bigger for the sake of being bigger. It's getting bigger to climb the pyramid and to be rewarded with higher multiples when it's time to actually sell the business. And so all entrepreneurs who start a business are probably thinking in their mind at some point, I'm going to sell this thing. I like to actually engineer it and pick where my exit points are and make sure that I'm hitting one of those so I'm rewarded with multiple expansions. So if you take any business in any industry, up the left side of the pyramid is the range of multiples that we trade for. And at the bottom of the pyramid, if I take my last empire build as an example, I bought 23 companies in 5 years. I bought 8 in the first 3 years. I bought 15 in the next 2
And
years.
did you go up the pyramid
And
as you were
I
scaling
went up
too?
2 steps,
Yeah.
up the pyramid. And so I'm buying all my companies at about 5 times. I'm selling my combined company at about 14 times. So for every dollar of earnings I buy down low, I'm selling it for $14 when it's time to exit. Banks loan me 100% of the $5 I needed to buy it. I pay off the debt when I sell it for 14, and the wealth creation is tremendous. And so I'm an orchestra, conductor on a big stage, and I'm doing it with, large institutional shareholders who got massive amounts of capital. And I decided, hey, this is how private equity makes its money. Wouldn't it be fun if I stepped out of the CEO seat and came down and I taught entrepreneurs down in the bottom 2 levels of the pyramid how to do this themselves, ahead of time to help them accelerate growth. And so I've been doing that for the last 2 years. I've been having a blast. It like reinvigorated my career. It's like, why should I be an orchestra on this giant stage building billion-dollar companies when I can help, thousands or hundreds of thousands, whatever it winds up being, entrepreneurs through my seminars, through my books. I can help them all become conductors of an orchestra. And so that's what I've been doing. So when I think about what we're trying to do, I start with an end in mind. I'm going to go up the pyramid one step. I'm going to go up the pyramid a second step. This is one hold period with one owner. I'll sell it another hold period, another owner. You can go up 5. You could have 5 different private equity owners as you're climbing the pyramid before you hit public company markets. Before size just dictates and mandates you can't stay private anymore. You need to go public.
Well, and what's in what I a couple comments, Adam, is like out of God, man, I have to have had at least 100+ interviews with people that are PE backed or in the PE space. There's
Yeah.
2 stories that I'm thinking of that outside of yours that hammers home that what you just said is possible. Blue Sky Restoration. I don't know if you're familiar with those guys.
Yeah.
They were on the podcast, and they're on their third PE partner right now, and then Service Express is Ron Alvasteffer, and he's on his third one too. And they literally have hit every single stage that you're talking about. And but what I think was important about their stories, from what I gathered, Adam, is they were clear on what the company's potential was the whole time. And so it was almost like what you're saying is what they did is they said, hey, this is what the company is capable of being. And then they just changed their capital partners on the way versus
Yep.
someone going, hey, I need money. And then they're just chasing to the person
Yeah.
that has the money.
I lay it out here. I've got a graphic in
Yep.
my book which
Yep. I
shows
love
the
it.
PE pyramid, so
We'll
people
put
can
it. We'll
like
put an image in the show notes for the listeners.
yeah, and so it's so the second part of your question was kind of the evolution of the entrepreneur and what are they doing at these different stages. And again, remember, to beat the odds, to be one of only 7% of business owners who not only survive but they get to 1 million in revenue, or being one of the 4% that get to 10 million, you had to be an anal retentive control freak. You really had to be dialed in on everything that was going on. You had to know all, be in front of all, and you had to really put your arms around this business to get it to grow to that certain stage. But then it's like no one teaches you the different behaviors. And so you continue being what you are. And that's why you top out at like this glass ceiling. And you gotta learn how to make these entrepreneurial shifting gears. And so, it's all about unit level economics and creating a repetitive nature of profitability when you're small. When you finally get to call it that $10 million size, all kinds of new opportunities open up. And in order to take advantage of those, you have to stop managing minutia and start really managing strategy and process. And I lay out, how to go into adjacent markets and the different methodologies. And again, at some point, I want a partner. I want a
Is
capital
that where you
partner.
would bring up? Is that
Those are
some?
kind of
Okay, I
that's
wasn't.
another one.
Okay,
Yeah,
maybe we can get to that in a second. But I was holding up another graphic for the listeners then. But yeah, you keep going. Sorry.
yeah, no, no, not at all. So it's like, and I think people who, I've said this before. It's like, if I tell you get in a car and drive and you're in LA and I don't tell you where to go, you drive around in circles. If I tell you get in a car and drive to New York, you're headed east. It's more than a 1 day trip. You're going to have to stop. You're going to have to create waypoints. And, there's a certain amount of things and behaviors that you'll build into the trip and then you'll be successful. The problem with most people when they start is they don't have the destination mapped out and they don't know when they've arrived, and they just
Do they even know where they are? Usually.
oftentimes not, and so they're on that treadmill and they're running through life. And, before long, it's like 20 years have gone by. And no matter how wealthy we are, the one thing we can't buy is time. And
Mm-hmm.
we have such a finite amount of time in our careers that we have to be efficient with the use of that time. And so if a business isn't going to work, I want it to fail in the first million, not 20 years later while I'm struggling, to get it to 10 million. And I'm
Well,
not
it's
making any money along the way. I'm just eking out a living. And now I've got a garbage pile and I'm trying to sell it so I can retire.
yeah, it's
That's
like yeah, right. And um, one of the things that I think oh God, I think I might have just lost it. I was thinking about the journey up. Come on, Ryan. So I know the destination. So here's what I've noticed with all of my events and exposure is valuations is becoming one of my obvious massive topics that people don't understand as from what I've gathered, Adam. So like, because like we can sit here and you and I could talk about multiples and arbitrage and like how you're gonna like how much the debt to equity ratio we're gonna be leveraging all that stuff. But if people don't know how valuations work, so
yeah.
like I mean like and I'm curious because of how many deals and how many entrepreneurs you've talked to, especially in the same size like the Vistage crowd that I speak a lot to is like what is your experience with their understanding of valuations in general?
Well, first I'll tell you they have almost no understanding of their own finances. So I coach people on the income statement, and I consider the income statement it's a set of stairs, and I'm walking down the stairs. And if I have my finances set up properly, I have revenue at the top. I take out my direct operating expenses, I get to gross profit. I take out my SG&A, I get to my EBITDA, and it's like and I map out the walk down the stairs. And when I get into a business for the first time, what I often find is there's one step. It's like it's a jumbled mess of goo. And
I
keep in
jumble
mind,
as a go.
it-
I,
keep-
I had to say to someone recently, I'm like, I hate to break it to you, you don't have 100% margins. You just don't have cost of goods.
yeah, yeah. It's so what I tell people is, look, all the IRS cares is about two things. Do you know how much you made, and do you know how much your profit is? Because that's what you got to pay taxes for. IRS doesn't care about anything in the middle. And I hate to say it, but most accountants don't care about anything in the middle either. And so oftentimes when I get in working with an entrepreneur, the first thing we have to do is kind of get the chart of accounts straightened out, make sure that expenses are hitting the income statement at the appropriate places so I can apply the 30-20-10 rule to see what kind of health the business
Yeah.
has.
Yeah.
And then I can help coach them. And so I would say most entrepreneurs that I meet don't have a good command of their financial statements, their basic financial statements, and they don't have a good picture for what the true financial performance of the business is. That's
Okay.
number one.
Yep.
Number two, even if they've got that right, oftentimes they're fixated on on my revenue. Well, I don't sell as a multiple of my revenue. I sell as a multiple of my earnings. And yes, it does matter what my earnings are. And in most entrepreneurial journeys, it's like they're programmed to not pay taxes, and so
Mm-hmm.
we write
Mm-hmm.
everything off we can. And it's like I have zero income. Well, congratulations! If you're selling a business with zero income, you're getting zero for it because
I know
it needs,
because
because it needs to have income because you sell it as a multiple of earnings, not as a multiple of revenue, with few exceptions. And so, end result is, I think most entrepreneurs are probably really good tactically at operations, whatever their operations are. If they run a service business, they know dudes and trucks and stuff. And if they're real estate investors, they understand what a good property looks like and how much I can charge for rent. But they seldom outside of their niche have a broader area of expertise, that's in what I'll
Mm-hmm.
call finance and accounting and investments, even
Mm-hmm.
investments. We touched on that. So what happens when we sell a company, we get a pot of gold? First thing we have to do is figure out where to invest it. So
Right.
I'm a big, proponent of, well, why not roll over some, keep it invested where you're at and keep on building the company because that's your area of expertise. Take a bunch of money home, hire a wealth manager to manage it. Just make sure his last name's not Madoff, and you know,
Betters.
or Sam Bankman Fried or whatever. It's like make sure you got real people that know what the heck they're doing and they're real companies. But so it's as entrepreneurs we have to recognize that our area of expertise is narrow and highly focused. And I think the biggest hindrance to our continued growth and success is not realizing that we need to surround ourselves with other people who've got other areas of
Mm-hmm.
expertise that can help us expand and grow. I've got one client I'm working with now. He's got an empire that's worth well over 100 million, and he's got investments all over the globe. And I told him, what you're missing is you need a chief of staff. You need a CFO. Instead of running around from one continent to another, attending meeting after meeting, you need a team of people. You need to figure out which rooms you need to be in and which rooms other people can be in order for you to increase your bandwidth so that we can take that $100+ million empire and turn it into a $500 million empire in the next 5 years. And I write about it and I talk about it in here too. It's high value work versus low value work.
Mm-hmm.
And all of us in any job, there's things we do that we have to do. It must get done. It's important, but it's low value work. And then there's high value work. When I'm strategic and I'm thinking with my mind about building an empire and monetizing it and my strategy around value creation, that's high value work. When I'm with my clients and I'm talking to them about their businesses, that's high value work. Doing invoices every month, that's low value work, but it's got to be done. So someone's got to be doing. So we have to learn as entrepreneurs, where's our sweet spot? Where's how do we offload low value work so we focus
Well,
more
and
of
then
our time?
how do you keep shedding as you're going up the pyramid too, right? Going back to like where you're
Sure.
probably doing a lot of the work as a technician. And then as you get that next layer of management and you get some scale, then you're becoming more the manager, that maybe the front line, then the CEO, then more the probably, you're working on M&A at some point, you're a capital allocator, family office is probably to the point of where you want to get to.
Yeah.
If that's the track.
And interestingly enough, as you mentioned that, it was just dawning on me. In my career, I've held every job a person can hold on an org chart, and so literally, I was the dude in the truck, and
Mm-hmm.
then I was the dude in the truck's manager, and then I was the regional man. And I mean, as I climbed my way up an org chart all the way to CEO, and now executive chairman of some companies, I think I learned those behaviors about what to do at different sizes because I actually
Did them.
made the journey as an employee. And when we make it as an owner, there's nobody to hold us accountable. Nobody except
Mm-hmm.
ourselves. And so, I work with a lot of owners too, who, some of them unfortunately are struggling in a tough economy in some areas. And, it's like the only person that can make it acceptable to earn 4%, or 2%, in a year is you. And if I was the CEO of your company, if this was reversed and I had a board of directors, I'd be fired, if
Well,
I
right.
didn't
Yeah,
hit,
what
my targets.
I
And
agree, Adam. And you know what, a way that I like to think about this is like, when if I force people to start thinking like an investor. So if you and I had a $10 million to invest and we were looking for $1 million cash flow company, we want that cash flow to grow, right? Like that's our
yeah,
only objective. If we
yeah,
and I are going to place the money down, we want to place the money down so it grows.
yeah,
And you and I, if we understand this game, we could go to manufacturing, we could go to SaaS, we could go to
yeah,
services, we could go to e-commerce, and then we're going to look at the risks of all those, and then we're going to
yeah,
look at the people, and we're just going to go down the layer of like, are we going to get more money back? That's
yeah,
like that's it. And like I just find it so interesting. Like for the people that choose to get that 2% return and choose to continue slogging through it, it's like you're just choosing to like by keeping your company, you're rebuying the same crappy situation over and
yeah,
over again instead of stepping back and like, and I don't know if it's because so many people, the founders came up from their skill set that were like, they don't realize like I could actually place $1 million in manufacturing even though I'm in distribution. You know what I mean? Like,
yeah.
or like whatever it might, it's like this narrative is like, hey, I have to stay in my lane. But like what you're
And
talking about, we're looking
again,
at
I think
everything.
when people top out, that's one of the reasons why they stay topped out is there's
Mm-hmm.
no one to hold them accountable. And if my growth rate is 0%, my board, is going to give me a pass for the first year and fire me by the end of the second and bring in somebody else. And the mandate
Mm-hmm.
is you're going to grow at 30%,
Mm-hmm.
Mr. or
Mm-hmm.
Mrs. CEO, because that's what's required. And I think a lot of times as an entrepreneur, we don't know what good growth is. And when we plateau, we accept it, and we
Mm-hmm.
don't push ourselves to try to reinvent ourselves and try to figure out how to navigate higher. And so it's a lack of accountability. And I think peer groups and having mentors and coaches, that's where we start to try to put some accountability, in and get somebody else's input on our level of
The
success. And
one other thing that I see that people struggle with in these groups, Adam, is people go in there, and I'm trying to help people burst through this. Is like it's all these revenue goals. Who
yeah,
gives a shit? We
yeah,
owned a $21 million company that lost $1 million in '09. It doesn't matter. If we would have sold, we'd owed the bank money. So it's like I'm trying to help people think through that. Where it's like when even with these peer groups, to your point that you've made multiple times, is like, what's the goal though? It has to be the right
yeah,
goal. And it has to be a valuation goal based on earnings, not just some arbitrary revenue goal that made you feel good in front of your peers. And I find it so fascinating how long this has kept up. You know what I
yeah,
mean? We're like in I want to go back because you had mentioned the financials. You talked about the stepping down in the income statement. And again, we said this before we hit record, is like I got a D in accounting. I was a copy sales rep, and I didn't realize this over until the last handful of years. It's like the ability to read, especially a cash flow statement. We were a distribution business. I mean, like
yeah,
we were everybody's bank because we
yeah,
didn't know what the hell we were doing. And so I find it like, again, I'm saying I'm going down this rabbit hole because we thought we were different and we thought everybody else had it figured out. And I had that narrative for a long time with on the financials. And then what I've noticed, Adam, is even the most like I take an owner of a marketing agency or something like where it's more creative than more like engineering, where engineers like kind of grab onto the numbers, is like business owners. I mean, like instead of diving into cash conversion cycle and saying that, I'm like, hey, do you think you can pay payroll with your receivables? They're like, no. And I'm like, how
yeah,
about your inventory? No. How about it? So I'm like, I think here's where I'm going with this. I've met so many entrepreneurs, and out of the 58 that you've bought, they've been able to tell one hell of a story of where they've been, where they are, and where they're going. But then you say prove it, and then they fall short.
yeah,
And it's like this massive gap in the financial situation, Adam. And I can't because I mean, you've been doing this a lot longer than I have, and I can't wrap my head around how did it get this way. And I've got a couple of theses, but I'm curious with how many deals you've looked at. What's the situation, man?
Well, I think for most people, it's like they don't know the mechanics of success because they've achieved some level of success. And so, therefore, they've never had to learn or adapt. And when times get tough, there's nobody to challenge them. And so they accept the level they're at, and everything gets cloudy from that point on. And that's why I buy a lot of 20 to $30 million companies, and I don't find a lot of $100 million companies to buy, is because there is this issue and problem. And if people can ultimately pick up and become more financially aware and astute, and then that's where they leave the one plateau and they start to find
Mhm.
additional runway to climb. So
Does it have it? Does it have to do with all the companies that you've been a part of? So here's part of my thesis. I want to know if you like totally think I'm crazy or not. So like, because I'll look at these companies and I'm like, how did you get to 70 million without caring about the cash flow statement? I just can't wrap my head around it. And so here's my
yeah.
unless you want to rally off of that first.
Well, I was just gonna say, I've met billionaires that I look at and I think, huh, really? It's like they're not any more sophisticated than some of the other people I've run into and encountered. They just,
So
they're
here's why, Adam. And like, what do you think? Does this hold up? And again, this is back the napkin, me sitting down with a glass of wine, going, "What in the hell is going on here?" But it's like I say, so market demand, because like there has to be a demand, like right after how you start this, needs not wants. So market
yep,
demand is met with entrepreneurial hustle, and that's where
yep,
like Mark Cuban talks about like as long as you're in the game, you can meet the demand. And then the third factor what I've wrapped my head around is the business model, where like a good cash conversion cycle, and that's a geeky part of this, but like if you get customer deposits, like your e-commerce, your insurance, your distributor, construction, you get cash from someone else, you don't have to give a shit about the cash flow statement because you just keep going. We've
yep,
brought on clients, Adam, as for our dashboard or our CFO services where they have negative equity because they've taken too much money out, but there's still millions of dollars in cash in the company. And I'm just like, so like my dad and I topped out because we were just looking at the income statement, but as a distributor, we got 1.5 million in payroll or in payables, we got 1.8 million in receivable, and like we were stretched thin and we couldn't by gut scale anymore.
yeah, yeah. Well, and keep in mind that not all businesses, not every business on the planet can get to 100 million or a billion in revenue. Sometimes we maximize the potential of a business or a market, and that's
Good
where I
point.
talk about the need and ability to
Mhm.
make strategic pivots. And if we've kind of topped out on market share for a given territory, for a given industry, what other strategic pivots can we make in order to build a larger addressable market where we can then find additional growth? And so, there's no end to finding creative ways, to grow a business, but we have to know where to look, and we
What are
have
your
to,
sort of
again.
recommendations for like market research of like total addressable market? Because as you talk about in the book, fragmented markets for sure. Then you got different geographic locations. What are some of your preferences for like
Well,
research tools?
Well, so you can spend a lot of money or you can spend a little money. And, on most industries, I can just do simple Google searches and I can find some database that'll give me, call it a directional idea of how big a given market is. There are certainly companies out there like BCG or Bain or a bunch of LEK, a bunch of different consulting firms that I can hire. And as a PE buyer, if I'm working with a PE firm, it's like, hell, they'll spend $1 million to figure out a 100
Mhm.
page answer to what I can find in a 30-second Google. But at least somebody's got to look. And then there has to be, a detailed report when we're spending a lot of money, and we have a fiduciary responsibility. So I'm joking a little bit, but generally what I find is I start with, I need a large addressable market, and I need to be, in a highly fragmented industry because I'm going to do buy and build, and I want to buy stuff cheap. And so, in a highly fragmented market, there's too many companies available, not enough buyers, purchase prices stay low. But as I aggregate them together, I climb the pyramid. And on top of all that, I'm gonna get it growing organically, and I'm gonna make strategic pivots and add new products and revenue streams. And it's like once you know how to do this and you know the secrets to it, it becomes easy. It becomes second nature. And I
Mhm.
think, unfortunately, for a lot of entrepreneurs, there's just no one to challenge them.
I
There's no
think you're
one
right.
to say, okay, congratulations, you were successful. Now what? Now
Well, and
what?
Adam, and I know I'm trying to be self-aware of whether it's confirmation bias because, like, I mean, we built out a financial dashboard and a CFO services over the last 3.5, 4 years because of the education part demanding this, the people that went through our training. And I see these masterminds, Adam, and everybody can go in there and just spew BS
Yeah.
unless you're looking at the numbers because it's like the numbers don't lie, and you know that from buying companies. I'm sure you heard lots of really good stories, and then all come the numbers, and you're like, was that the same story?
Yeah. And you know what? I would also tell you that interesting, little factoid about my career. I'm not God's gift to a balance sheet, or I certainly know income statements real well, or to cash flow statements. I always have CFOs and I have accounting departments, and I expect them to be the experts, and talk to me about the finances and what are the issues and what.
Let's talk about the people then, because I think that what I really loved is you started everything with you got to have the right people,
Yeah.
and you're talking about the culture. I have watched people that have more money than they know what to do with, Adam, and they can't figure it out. I mean, and I just think about like, there's one thing that Mike Bloomberg proved back in 2020 is even a $500 million can't buy people's trust because he spent.
Yes.
And so, like,
Yes.
you can't. Money doesn't fix it. It's the people. So, like, what did you learn about the people that you had around you?
So, what I recognized early on in my career, I've always run service businesses, and that is you can't, every company I've run, you could not store its product in a box and put it on a shelf. And, when something breaks, you take down a box of service and crack it open and sprinkle it, and magically stuff starts working again. And so, if you can't store your company's product in a box, and I would argue in today's world that even if you're a manufacturer, everything revolves around people and culture. But if you can't store your company's product in a box, your product's people. And
Hmm.
so your focus needs to be on building a really strong culture to get an engaged workforce who takes care of customers, who give us more stuff, and revenue rains from the skies. I want to grow revenue and earnings. In order to do that, I need people servicing customers and delighting them with whatever my product or service is. And in today's world, boy, everybody wants to be a TikTok star. Nobody wants to work for a living, and I'm going to be a social media influencer. Great. If we're all social media influencers, where the hell is the money coming to buy all the products we're going to social media influence? It's like somebody's got to work. And then when our toilet's backed up, who's going to come fix that thing? When my app doesn't fix it for me, and we're not ready for robot plumbers yet. So I think about, it's tough in today's world to get people to want to come work. And so we have to pay a fair wage. We have to have good benefits. We have to provide growth opportunities for people, because we're competing with, I mean, think about, just some of our industries, like trades based businesses, the shortage that we have
Oh
of
my gosh.
tradespeople because no one's been going to trade school, no one's been coming back in as the baby boomers are tapping out, and getting to retirement age. There's nobody coming in behind them. And so, we need to be good stewards to people. And I would tell you that I knew that a long time ago. And I think I was somewhat of a maverick because I was preaching the gospel of culture, in 2001.
Way before it
And
was popular.
today it's popular. Everyone has to. You can tell the difference between companies that pay it lip service versus those that truly believe in culture, and you see it in their numbers and their performance. But I honestly believe that you can generate profit by and also have a strong culture that takes care of people. These are not mutually exclusive concepts. And I think the earlier we learn that, the more we can solve for our people issues. And so for me,
What would be your words of caution or advice or whatever it would be for the listeners who you got the private equity firms out there who don't believe that, but then you have the ones that do believe that. And there's the typical narrative, like, private equity will grind you to a pulp and squeeze the last little, piece of red juice, or last
Yeah.
squeeze of juice out of that, compared to someone that treats them well. And I always say that if you've seen one PE firm, you've seen one. So I
Yeah.
try and make sure that that's kind of the narrative that people are having. But
Well,
how would you?
there's 6,000 PE firms out there. So you have good and bad and ugly in any industry that has $5 trillion in assets under management and thousands of companies that are out there. And so I think that, I'll go back to in 2020, when COVID was hitting. Aries was my PE sponsor at the time, one of the largest PE firms on the planet. Matter of fact, they're the world's largest non-bank lender and huge PE firm. They helped me start a foundation, and they seeded the money for that foundation. And the sole purpose in the beginning was to help our employees who were impacted negatively by COVID. So you can't talk to me about PE firms all wanting to grind the last penny of profit. I've worked with plenty who did care about employees and they cared about growth. And so I would tell you is it goes back to entrepreneurs not understanding private equity, not understanding what a good fit is, not understanding what questions to even ask about, am I working with a good partner? Would they be a good steward? Is their
Mhm.
reputation good? And so I would tell you there's good, there's bad in any industry. And there are, keep in mind, you hear the news never reports anything good. They only report bad things. And there are some PE firms that are out there that are distressed asset firms that are looking for problems, right before the chains go on the door and they come in and buy them up. And sometimes, the carnage that results is not the best looking. But had they not come in, there
Right.
would
It
have
was
been
not
carnage
necessary.
anyway. It's you know
100%.
so
100%.
I've been around all different kinds of investors that are looking at different types of assets. So I think just generally having a broader understanding and knowledge base, leads to an ability for an entrepreneur to grow a company, to be wiser about decisions that have to get made at different sizes, and then when it comes time to exit, what constitutes a good exit path and strategy. And you just hit on, in the last 5 minutes, all three of my books. It's like,
Mhm. Well, you know what I
it's like,
want, Adam, and that's why I want people to pick up all your books, to listen to this podcast. It's not about mandating someone going to private equity. You know what I want, Adam, for anybody? And I think about, because I just have such a vivid memory of like when my father and I were going through this exit, talking to all these advisors and having no freaking clue what anybody's talking
yeah,
about. And the thing that I want for people is, I like, if you and I were going to do a deal, Adam, I want to sit down and I want to know, is Adam a good guy? Are we
yeah,
gonna are we gonna be aligned on strategy for the company, aligned
right,
with people, the systems, the processes, the markets, the pivoting, the all that stuff. All the other shit is mechanical. But
right,
what I see is like, if all of a sudden you're like, I've been focusing on revenue, gross profit in my checking account for the last 20 years, and now Adam's talking about multiple arbitrage and roll carried in and carried interest and rolled equity, and like they're trying to they're trying to understand that, and they're not focused on, is Adam a good guy? Are we aligned? And
yeah.
that's why I think there's so many deals that get blown up. Is I just want someone to know this, so that way it's kind of like, instead of someone playing checkers, they sit down and they know that they're going to play chess with you, and then they can have good conversations and banter
Yeah.
while they're
Well,
playing chess.
and I'll tell you along those lines, when someone calls me with an opportunity and they think of me as an industry expert, I know they don't understand my value. When they call me and they think of me, hey, Adam, I've got the best idea ever and I need your wallet. I know they don't understand the value I bring to the table. It's like that's not how life works. I was the CEO of, I'm not an industry expert in anything. The first time I was an industry expert in each of the companies I ran in those industries was the day someone hired me as a CEO to run them. Right.
Right,
And so I
right.
become an instant, so someone says, geez, you're an HVAC guy or you're a laundry guy or a medical devices guy. And it's like, no, I'm not. It's like what I do, is
Business.
generic and it works in any industry. You put me in any industry and I'm gonna maximize the potential of the company that I'm given, and that's a process. That's a generic application of a tool set
Hmm.
towards any industry, any company. And so it begs the question, Ryan, why the hell don't we do something together someday? Maybe we ought to. Maybe that's the next
That's the play.
podcast.
That's the next
Yeah.
play. That's the next play.
Yeah.
Well, and because like it's like what we just said, Adam, is like I want people to realize that this is actually the game. Like the
Yeah.
game is not sell more stuff to more people. That's part of the game. That's one play of the game. But like to own and build and grow a company and not make it valuable is insane. Why would you
Yeah.
do that? So
Yeah.
it's like I think to your point, it's like, hey, this is the name of the game. And so like same thing with me, man. It's like if you talk about an e-commerce business distribution, like it doesn't matter. I'll tell you what, I'm very happy I'm not still talking about copiers every single day because that would suck. And like
Yeah.
and but yeah, I
You
think
know,
that
I'm
this is
involved in a dozen companies right now, Ryan. And I got to tell you, the vast, I want to say there's only one where I have any industry experience at all. And
it's
it's
decision making. Don't you think it's decision making on the way to
yes,
building that wealth, right?
yeah,
And it's like the wrong decision, especially the higher up you go, it's a real big deal if you make the wrong decision.
yeah. And so, there are some industries I like better than others for financial reasons or fragmented market or growth or tailwinds versus headwinds. But there's really no shortage of places where I could find great people and great companies. And for me, it's the people part you got to get right first.
Hmm.
Get that
Yep.
right, the rest follows.
So that agreed 100% that, but it's my next question is going to counteract that. And I know we're running short on time here, but I just wanted to, as we're wrapping up, is I've got this back of my mind of like kind of this like fragmented picture of like kind of the PE landscape because I can't look up and be like, where's every single investment? Who are the funds? Where are they at? But like I can only imagine the investment theses that these people raised with the IRR that they preached with I mean,
Yeah.
every single association I go to speak at them, people are like, "Oh my god, did you know that private equity's in here?" And they don't know that I'm like, it's in the veterinary clinic, it's in the
Yeah.
water treatment business,
Yeah.
it's in the HVAC business, it's in the death business, it's in every single industry.
I tell everybody it's like, you can't go a day, you can't go 24 hours without encountering a logo of somebody owned by private equity. You can't even go camping in Denali by yourself. It's half your camping gear will be from a company that's owned by private equity. It's like
Yes,
it's everywhere.
So, with that said, and with the couple trillion that's already been raised with the thesis, right? So, whether it's 1 or 2 or 1.5, I don't really care. But there's this, the GPs have raised this money and they had the IRR that they had, committed to or, thrown out there. And when you have rates that get turned upside down like this, and the margin compression, and you have all because Butcher Jost has been on the podcast once a quarter with ITR talking about GF data, like the multiples, and then the debt to equity ratios,
Yeah.
interest rates, and all that stuff. What do you? Is there something to be worried about in the PE industry about like people on when they're actually trying to sell their fund and
No,
get that IRR?
I don't think, so you had we had a decrease in deal flow earlier in the year. And I tell people really what was going on was a game of chicken. You had sellers who had inflated expectations. You had
Mm.
buyers who didn't want to pay it because
Yeah.
the interest, rates were higher and the debt leverage ratios didn't work very well. But at some point, the cardinal sin of private equity is you got to put your money to work. If you don't put your LP's money to work, you cannot raise a new fund. And so deal flow started picking up in the second half. So all that happens is, we look at all PE funds based on their vintage year, which is the first year they make their investment and they survive for 10 years. And so ultimately funds of this time period probably will have moderated returns versus funds that had lower interest rates, but
Hmm.
they'll be rated against other vintage funds that had the same economic cycle.
Got
And
it.
so at the end of the day, 5, 10 years down the road, it won't matter. I think as long as the asset class is beating the market, you'll continue to have an influx of capital. And it's been going that way. Jokingly, somebody said, Mitt Romney used to talk about in the 1980s how PE was a bubble. Well, that bubble continues to keep on going, 40 years later. And it's like, I just look at it as if we've got bad interest rates today, all funds investing today have that same economic, the
Yep.
same sea changes affecting all.
How
And
is the
so,
bond market doing? You'd be like talking about one of the bond dealers or whatever
yeah,
you bond brokers. It's like they're all dealing with the same thing.
they are. And so history will look back and they'll look at funds of vintages against other funds of the same vintage.
Got it.
Think of it like wine. 2013 was a great year for grapes and the humidity in
Yeah.
the mountains. And 2015, the same vinter put out crap wine, because it was a dry summer or whatever. It's like it will moderate, it'll normalize, and if you really think about interest rates anyway, we're kind of at what I would call historically, we're still not at go back to, what the
It's
interest
not
rates were in the
vulgar era of the night.
1970s or 1980s when it was 15% mortgages. It's
And
like
that was
that.
bad. That was when Blackstone and KKR got
Yeah.
their legs underneath them
Yeah.
too. Man, this has been so much fun, Adam. I'm really happy that we reconnected. I'm glad that you wrote another book and you're out there giving everybody the material that I think will just enhance their conversations. Play the right game, whether there's going to sell the PE or not. The same playbook's available to people, and I just absolutely love it. Is there anything that I didn't ask that I should have?
Oh no, we long ranging conversation. So next time we'll do. I'm gonna do it with an old fashioned in my hand. We'll do it at night in a cigar bar,
I
and we'll
like
set
it.
up or something. Yeah. So yeah, good. Fun as always to see you, Ryan. People can reach out to me on LinkedIn or go to adamcoffey.com and
Got all your books out there. You got all the
yeah,
stuff
so
out there.
people can find me. I'm not hiding.
Adam, thank you so much for coming on the show. I had a blast, man.
Hey, good to see you, and thanks to all your listeners for hanging out while we rambled on.
Well, that's a wrap. I really enjoyed the conversation with Adam, and I hope you did too.